So, what is financial statement fraud? Financial statement fraud is an intentional act of misrepresenting the financial statements in order to affect the share price of a company, or to gain some bonuses or other advantages that are attached to the fraud. Now, we need to make a difference between financial statement fraud and an error. An error um, is an unintentional act. And now, who commit financial statement fraud into a company? We could ask ourselves, what's the profile of a fraudster into a company? And we can say there is no clear-cut profile of someone who would be labeled as a fraudster. First, start with somebody as you and me, who is who've got a good reputation, and they would commit that fraud maybe because they have some kind of pressures, they want to meet some target. The culture into the company is very severe against people who don't meet their target, so they would commit those frauds most of the time because they want to meet that target. But as time passes and as they succeed in getting away with those with that fraud, they become greedy, so they tend to commit more frauds after that. Now, why do people commit frauds? Now, if you see a fraudster and you ask him why he commits fraud, most of them will tell you they don't know, because it the way it starts, you don't look at it as a fraud. You just think, okay, I'm going to do this. I'm going to take advantage of this kind of blurry area of the accounting standards in order to adjust the figures in order to meet the target. And later on, you realize that you're kind of caught into a cycle, and you commit a fraud. For example, for a quarter, you adjust the figure of a quarter by borrowing to the next quarter, but you don't know really what's going to happen during the next quarter. It may happen that the activities would be very good, and you could adjust for the amount you borrowed to the next quarter. But also, it could turn out that the next quarter is kind of like the previous quarter, or even worse than the previous quarter. So in those cases, it makes adjusting the fraud difficult, and basically that's how people get caught into that cycle of fraud. You borrow to the next quarter, and then you borrow to another quarter, and the fraud becomes massive and massive. So you get stuck into that actually. Now, what are the prerequisites for fraud? According to the Association of Certified Fraud Examiners, there are 3 prerequisites to fraud. And the first one is the motivation. Motivation is what motivates a person to commit fraud. It might be the person needs some money. It might be that the person needs to meet a target. It might be that the person is worried about their position. They may get sacked because they didn't meet a target. It could be that the person is addicted to some illicit substance, and they need a lot of money to finance their consumption of that substance. So those are some of the things that can motivate somebody to commit a fraud. Now, after motivation, what you have is the opportunity, and opportunity is another very important element in the fraud cycle, because you could have the motivation, you could be motivated to commit fraud into the company, but if you don't have that opportunity, you wouldn't really be able to go on with your intentions. An opportunity could be some weak controls into the accounting system of the company. The internal controls are not so good, so there are ways in which somebody could adjust the figures into the company without really being noticed. So those are the the opportunities. And another opportunity could be that somebody is there's no segregation of duties into a company, so somebody is actually responsible for doing a task from the start to the end. So during that process, if he adjusts something, if he does something that is not allowed, there is a very small likelihood that it will be noticed, because no one is going to, he doesn't share the task with somebody else. So yeah, that can be also an opportunity. Now, the third element is the ability to rationalize, and the ability to rationalize would most of the time also depend on the nature of the person. So if the person is would easily rationalize a fraudulent act, the person would be more subject to committing fraud than a person who would not easily rationalize frauds. Now, what are the upsides and downsides of frauds? So, what do a fraudster gains and what does he lose? Well, what a fraudster could gain from a fraud would be financial rewards. Could be that he would have an increase in salary. It might be that he would save his job. It might be that he would get some bonuses. So that's most of the time the upside of frauds. Now, what's the downside of frauds? Well, the downside of the frauds, first of all, is that the person would get sacked. It could be also that it would give a bad reputation to a person and to the company also, because once a company is found to have misrepresented its financial statement, it reduces the trust and confidence that the stakeholders would have toward it, and also it reduces the confidence of shareholders, which would then affect the share price of the company. So those are the downsides. And for audit companies who get sometime stuck into or splashed with a fraud scandals, they have also a reputation problem, because companies wouldn't trust them. And we could see the example of Arthur Andersen and how they had to stop operating because the level of confidence that the public had toward them was very small. Now, fraud doesn't start with a dishonest person. Most of the time, people who would begin a fraud would be very honest people who just want to get away of kind of a difficult situation or a tricky situation. It may be that they've got a serious problem, they need some money. Could be that they're saving their job. So it doesn't really start with people who get up a morning and say, hey, I'm going to commit fraud today. So it doesn't start with dishonest people. Now, secondly, it starts with pressure. If people don't have some kind of pressure, they wouldn't really be motivated in committing a fraud. And the third element is that it starts really small. So people will start with a very little amount of, and when they get away with that amount, their appetite would increase and increase. The fourth element is that it starts with hazy areas of financial of accounting standards. So if accounting standards are really clear cut, it would be difficult to start a fraud. Now, the fifth element is that fraud grows with time. So, if somebody succeeds with with a fraud of a small scope, the person wouldn't stop. Although it starts with some pressures, and it start with some pressures, and the person commits the fraud in order to reduce or to eliminate that pressure. The truth is that even when the pressure stops, the fraud continues. And also into the corporate environment, rarely do pressure really stop. So you do well during these quarters, and the shareholders are very happy, and they want you to do better during the next quarter. They want the figures to increase and increase. So the pressure really doesn't reduce, but even in the eventuality that the pressure reduces, people wouldn't stop with fraud, because they would get greedy. They would realize that, there's this way I can do to get more money. They would keep doing it until they get caught. Now, to reduce or eliminate the risk of fraud into companies, governments, public, and companies came together to issue some rules that are called rules of corporate governance. And what's corporate governance? Corporate governance is a system by which companies are directed and controlled for the interests of shareholders and stakeholders. And what are the tools of corporate governance that are that companies use to manage fraud, the risk of fraud? And those elements are the board of directors. The board of directors is the body into a company that controls the company and make sure that the company is well managed. And we have two types of directors into a board. This is if you're talking about the unitary board, which is the Anglo-American model, and we have executive directors and we have non-executive directors, and the non-executive directors are outside directors who are basically there to oversee the executive directors and make sure that what the directors are doing is what they are supposed to be doing. Now, a board of director would have a number of committees, and one of those committees is called the audit committee. Now, the audit committee into a company is there to make sure that the internal audit and the external audit are done well, and also that the system of corporate reporting into the company is sound in order to produce good financial statements. And internal auditors are auditors that work for the company and that get paid by the company, and that are inside the company, and their role is to build a system of internal controls that is sound, and is which means that it's capable of producing good financial statements, and also it's capable of reducing the risk of fraud and error. And another of corporate governance is the external auditors, outside auditors who audit the financial statements of a company in order to give their opinions on whether the financial statements give a true and fair view of the financial position and the financial performance of the company. So Now, what are the reasons that these tools sometimes fail? Now, starting with the audit committee, we would say that most of the time, there are three reasons why the audit committee wouldn't spot a fraud into a company. And the first one is that most of the time, members of the audit committees are not really independent in form and substance. And what does it mean? It means most of the time they are some way related to the directors in such a way that they wouldn't be very objective in their judgment. So that's the first reason. Now the second reason is that they are not always well researched in terms of competence and most of the time in terms of competence. And another reason is that most of the time members of the audit committee also wouldn't really know their role as member of the audit committee. Sometimes they might think that, okay, our role is just to listen to external auditors and internal auditors and just listen to them and see if they report something wrong with the company, and if they don't, it means that's fine. So that's the reasons why the audit committee would sometimes fail to spot a fraud into the company. Now, moving on with the internal auditors, what we can say is that they are really well placed in terms of being able to spot the fraud, because they're inside the company and they have that chance to be very close to those who commit frauds and to the accounts of the company. But also, one of the problems that makes them sometimes inefficient is the fact that being employed by the company, they don't have independence in terms of the area of the company that they would audit and the scope of their audit. I know sometimes they could also be limited. They could be limited in terms of the budget. So if the company allocate a small budget to them, they really wouldn't be able to go and do a lot of extensive procedures to spot a fraud into the company. Now, moving on now with the external auditors, the reason why external auditors wouldn't spot fraud easily into a company is the fact that external auditors are external, so they don't have the they are a bit remote from the account of the company, and when they come for their audit, most of the time wouldn't spot a fraud when it starts, because it starts with small amounts. It most of the time fall under their materiality threshold. So because in auditing they will have a threshold of materiality, so anything under that threshold is deemed to be non-significant, so wouldn't really affect their opinion about the truth and fairness of the financial statements. If those tools that are put in place by the corporate governance to spot fraud don't work, how does fraud surface? So how do people know about a fraud? What we can say about that is that fraud can be spotted by chance. So somebody just come across the fraud and report it. Now, another thing is we could have some whistleblowers. It could be that one of the people that were involved into the fraud they want to report it. They want to say, "Oh, actually, we did this, and I just want the public to know." So it could be that one of the people who perpetrated the fraud will reveal the frauds to the public, and actually, a study by the Association of Certified Fraud Examiners found that most of the time, neither the external auditors, the audit committee, or the internal auditors would be more efficient in spotting fraud than the whistleblowers. So, conclusion: what we can say is that financial statement fraud is an intentional misrepresentation of the financial statement of a company in order to gain bonuses, to manipulate the share price of the company, or to gain any other gain that's attached to the fraud. Remember to subscribe for more videos into the future and leave your comments into the comment section. Thank you.